Hello friends, I am Sandip Agarwal. Welcome to my YouTube channel Financial Markets by CS Sandip Agarwal. This is the video number 1 under Options Advanced series. So this is the last part. So like till now we have covered 12 videos under 3 part, 4 videos under Option Basic, 4 videos under Options Intermediate Part 1 and 4 videos under Options Intermediate Part 2. This is the video number 1 under Options Advanced and video number 13 under the Total Option series. After this video, we will have another 3 videos and this will complete the entire option series from basic to advanced. So in case anybody wants to learn the options from basic to advanced, so they can see my entire 16 videos and it will give them a very good understanding about the options. I hope you people are liking my videos and the content. And in case you are liking, please do a like and subscribe to my channel so that you can get notification to any future videos which will be uploaded in future. Also, in case you feel that my videos are adding value to you, please share the same with your friends and family so that they can also get value addition from my videos. So let's start this video. So under this video, we will understand 3 important concepts. One is put call parity, second is synthetic futures, and third is implied futures. So just remember this 3 terminologies, and we will explain these 3 concepts with the help of theoretical knowledge as well as the practical knowledge as well in the next few slides. So put call parity means the difference between the option price of call and put option of same strike price and same expiry should be equal to difference between the futures price and the same strike price and expiry. So just to break this text by way of an example. Now say if currently Nifty, the underlying instrument in our example, is say trading at 17,500. Now the put call parity says that the call option price of 17,500 strike price minus put option price of 17,500 put option price should be equal to the futures price of the Nifty minus 17,500 strike price. So this is called the put call parity. So this should always be there in the market in order to avoid any arbitrage opportunity. Now what I have explained in the first para, I have explained the same with the help of an example in the next line. 17,500 strike price of Nifty call price minus put price of 17,500 strike price is equal to futures price of Nifty minus 17,500 strike price. So this formula you will see generally holds well in the market. Otherwise, there will be arbitrage opportunity. I will explain you how this arbitrage opportunity can be used to your advantage in case you are able to find this arbitrage. Now see this example on my screen. What I have done, I have taken the buy of the April 2022 Nifty contract, and at the same point of time, what I have done, I have sold a 70,500 call option, and I have bought a 70,500 put option. Now you can see in the below screen the payoff graph. You can see the max profit is 0 and the max loss is 130. Now this example I have taken as on date of 1st of April, and this is for the 28th April expiry contract. Now you can see that irrespective of wherever the Nifty moves, the chances of profit is 0 and the chances of maximum loss is 130. Now somebody may say that this loss should be 0 going by the put call parity, but there will always be a minor difference of 3-4 points, which will translate into 200 to 300 rupees only, because one lot of Nifty contract is 50 quantity. So 3-4 points multiplied by 50 will be 200. So this 200 will in any case will be equivalent to the brokerage cost which the person will incur by initiating this three different trades. Now this is an example just to show you that why the put call parity always stays in the market. Otherwise, there will be an arbitrage opportunity. So you can always and you can also see that the delta of this trade is almost zero because the person has gone long on the futures. So the delta is 100, which is 1. So it means that in case the Nifty moves up by 1 point or the Nifty moves down by 1 point, then the person will make a profit of 1 point or they will make a loss of 1 point. So that's why the delta is 100. Now you can see the delta of 70,500 call is minus 62 because the person has basically sold a call option. So that's why in case the Nifty moves in the upward direction, so the person will make a loss of 0.62 rupees per point movement in Nifty, whereas in case the Nifty moves downward, then the person will make a profit of 0.62 rupees per 1 point of movement in the Nifty. Similarly, the person has bought one lot of 70,500 put option strike and the delta is negative. As I've explained in my earlier videos, the delta of put option is negative in case somebody wants to go long. So in case the Nifty moves in the upward direction, then the person will make a loss of 0.38 rupees per 1 point movement in the Nifty. Whereas in case the Nifty moves in the downward direction, then the person will make a profit of 0.38 rupees per 1 point movement in the Nifty. So you can see the delta is almost zero. So this is what the put call parity. In the next slide, I will try to give you an example. What in case this put call parity would not have hold put. So basically in this slide, I have taken the same example as of the previous slide. The only change which I have made is that the call price of 70,500 I have modified from 467 to 500. Now in the previous slide, if we see, the person has basically bought one futures, sold a 70,500 call option strike price and bought a 70,500 put option strike price. Now, if we exclude the futures, then the person has basically received a premium of net basis of 233 points. So he has received a premium of 467 and paid a premium of 232. So the net premium received by him is around 233 points. And the person has initiated this position at 70,500 strike price. Now you see, the Nifty futures currently is trading at 70,737.95, which is around 237.95 higher than the 70,500 strike price. So you can see also like this is that the access of Nifty futures over 70,500 strike price is equal to the difference between the premium of 70,500 calls option and 70,500 put option. So in the next slide, what I have done, I have basically modified the option price of 70,500 call option from 467 to 500. Now you can see in this example, this trade is also initiated on the 1st of April data only for the 28th April 2022 Nifty April 2022 expiry contract. And I have basically modified the call option price, and you can see in this case the max loss is 0, whereas the max profit is 150. So in case this kind of opportunity is there, so the person can definitely initiate this because there will be no loss and there will always be a profit. Obviously, in case somebody wants to initiate this position, so there will be certain margin requirement as well, which the person has to maintain. But this is like a riskless approach. So the margin required for initiating this a set of trade is around 1,10,000 rupees. So you can see the person can easily make a profit of around 1.3 to 1.4% on the capital deployed for initiating this. But it's very rare to find this kind of trade. You will always find put call parity to remain in the market in case somebody wants to initiate these three trades at the same point of time. Obviously, if somebody initiate this three trade at different point of time, then the put call parity is not said to apply at that point of time. This put call parity holds good in case somebody wants to initiate this at the same point of time. In this case also the delta is 0. Now The second concept which we are going to explain in this video is a synthetic futures. So synthetic future is basically an alternate way of going long and short futures. Now, if somebody is bullish on the Nifty underlying instrument, so the person can make money either in three ways. He can simply go and buy a Nifty future, or the person can go and buy an ATM call option, or a third way is that the person can buy an ATM call option, and at the same point of time, he can also go and sell an ATM put option. Now, buying an ATM call option and at the same point of time selling an ATM put option is equivalent to long futures. I will explain this with the help of an example in the next slide. Why? If you recall my earlier videos, I have explained the delta of ATM call option is 0.5 and the delta of ATM put option is also 0.5. In this case, the person is buying an ATM call option, so the delta will be plus 0.5. And at the same point of time, the person is selling an ATM put option, so the delta in this case will also be plus 0.5. So it will be 1, whereas the delta of long future is also 1. So this is called synthetic futures. So in case the person is bullish, is super bullish on the market, then instead of initiating a long future, the person can go and buy an ATM call option. At the same point of time, they can also sell an ATM put option. Now, somebody may ask why somebody will take these two trades instead of doing only a long futures. So this is just in order to avoid only the transaction cost, because the transaction cost in the case of trading in futures is much higher as compared to the options. And in case somebody wants to go long or short in futures, then whatever is the MTM, that is the movement in the Nifty futures at the end of the day, whether it is positive or negative, has to be settled on daily basis. So in case the position goes wrong against the person, and at the end of the day, the MTM is negative 50,000 rupees. So before the close of the trading day, the person has to fund his account by 50,000 rupees, which is not the case in case of doing this option trade. So that's why somebody also does this synthetic futures by buying an ATM call option and selling an ATM put option instead of doing the long futures, in order to avoid the transaction cost as well as in order to avoid the funding of the MTM loss as well. Similarly, this kind of synthetic futures can also be deployed in case of the short futures as well. If somebody is very bearish on the market, he can go and short the futures, or at the same point of time, he can go and buy an ATM put option. At the same point of time, he can go and sell an ATM call option. Now, if we refer to this example, we can see in this case, the person has basically bought a futures of the April 22 Nifty contract at 7,737. The probability of the profit is around 47%. The break-even level is 7,738, and the estimated margin which is required to be kept with the broker is around 1,08,000. And on the right-hand side of this slide, there is a payoff graph. You can see the payoff graph looks like this. Now, in the next slide, we will see this payoff graph, the probability of the profit and the estimated margin by doing buying an ATM call option at the same point of time selling an ATM put option. Now you see in this slide what we have done. We have basically bought an ATM call option of 7,800 strike price, and we have sold an ATM put option of 7,800 strike price. So you can see again the margin is almost similar as it was there in the case of futures, which was around 1,800. In this case, it is around 1,90,000, and the probability of the profit is almost same, 46.8%, and the break-even is almost same. The previous slide example, it was 7,737, whereas in this case it is 7,742. So it is higher by only 5 points. And you can also see the payoff graph as well. The payoff graph is almost the same as it was in the case of the long futures. Now, the similar kind of synthetic futures, you can do it on your own. On the short side, you can see the example by plotting in one slide doing only short futures, and in another slide buying an ATM put option and selling an ATM call option. Now, this both the examples of synthetic futures I have taken from a website called as Obstra Define Age. You can also use that website for doing this simulation. The basic version of that data is free, and this data can be easily available on that website. Now, again, just to give you a disclaimer, so this examples are just to give you an understanding about the put call parity and the synthetic futures, and this is not a trade recommendation. The third concept which we are going to discuss in this video is the implied futures. So we have discussed till now put call parity and the synthetic futures. The third concept is the implied futures. So as I explained in my previous videos under the options basic, I have explained you that the option price of the call and the put option basically moves on the basis of the Nifty futures price and not the Nifty spot price. Now, if you refer to the contract expiry data of the underlying instrument Nifty, you will see that there is also a weekly expiry on every Thursday, in addition to the monthly expiry, which is at the end of the month. Now, the option prices are also there for the weekly expiry as well, and at the same point of time, it is also there for the monthly expiry as well. Now, the weekly's option pricing is neither based on futures nor it is based on spot. The monthly option pricing are based on the Nifty futures, whereas the weekly option pricing are neither based on the futures nor based on the spot price. Why? Because in every month there is only Nifty futures for the month contract only, and there is no Nifty futures price for the weekly contract. So how do you calculate the implied futures? So it is basically calculated based on the options premium. Now, say for an example, Nifty is trading at, say, currently at around 70,700. So what we can do? We can take the price of 70,700 strike price call option and the put option of the weekly expiry. And what we can do? We can deduct the put price of 17,700 strike price from the call price of 70,700 strike price and add it to the Nifty spot. So this will give you to the implied futures. So let's say for an example, if the Nifty spot currently is trading at 70,700, the monthly Nifty futures is currently trading at 70,750, so which is around 50 points premium as compared to the Nifty spot. And the difference between the call price and the put price of 17,700 strike price of the April contract is, say, around 10 points. So the implied futures for the current weekly expiry become 17,700 Nifty spot plus 10 points, which is the difference between the call price and the put price. So it becomes 17,710. So this is the implied futures. So that's it from my side in this video. I hope you have liked the content. In case you have any queries with respect to the put call parity concept or synthetic futures or implied future, please feel free to give your feedback and ask questions in the comment box, and I will try to address the same in the next. Thank you.